Welcome to the Byte-Size Brief. Today, we are putting Ellington Financial EFC, that's EFC, completely under the microscope. Let's get into it.
Yeah, let's do it.
So, imagine buying like a high-end money printing machine for your living room. You know, it just spits out crisp dollar bills every single month. And for a while, you feel like an absolute financial genius.
Right, living the dream.
Exactly. But then you look a little closer and realize there's a catch. To keep that machine running at full speed, you actually have to slowly sell off parts of the machine itself.
Ouch. Yeah.
And eventually you're left wondering if you actually made any money or if you just, I don't know, systematically dismantled your own investment.
That is honestly a phenomenal way to frame the core tension we're looking at today.
Yeah.
Because the mission for our deep dive into these sources is to figure out if that massive double-digit monthly dividend yield of EFC is a brilliant, sustainable income opportunity for your portfolio.
Or a massive value trap.
So a high-risk value trap just waiting to spring shut. And to make sure we're dealing with the absolute latest reality, we've isolated the scope of our sources to the most recent 3 months of SEC filings, their Q4 2025 earnings data, which came out in February 2026, and the upcoming Q1 2026 projections.
And to set the stage for you listening right now, EFC is currently trading around $13.14 a share. And depending on, daily market fluctuations, that translates to an annualized dividend yield hovering somewhere between 11.9% and 13.2%.
It is huge.
It's massive. And here is the kicker that really gets people's attention.
Yeah.
They are paying out 13 cents per share every single month.
Yeah, the monthly payout is undeniably the primary magnet for retail capital.
Oh, I mean, I cannot stress enough how much retail investors absolutely love that kind of setup. You're looking at an average yield of around 12.4% right now.
Correct.
In a volatile market where capital gains are just so unpredictable, everyday income investors are constantly hunting for steady, reliable cash flow, getting a paycheck from your investments 12 times a year instead of the traditional 4.
It's psychologically very appealing.
It is. That's the dream for anyone trying to build a passive income portfolio. Feels like you're actually seeing your money work for you in real time.
I wouldn't celebrate just yet, though, because we have to apply a healthy dose of financial gravity here.
Okay, lay it on me.
Well, that yield doesn't exist in a vacuum, and you are paying a hefty premium for the privilege of accessing it. If we look at the valuation data, EFC is currently trading at a price-to-earnings, or PE ratio, of 13.8x.
Which, I mean, that sounds incredibly low if you spend your days looking at tech stocks trading at 30 or 40 times earnings.
Sure, but we aren't talking about hyper-growth tech stocks here.
Right, completely different sector.
Far from it. We're talking about the U.S. mortgage REIT industry, where the average PE is roughly 10x. Their direct peer average is around 10.5x. So out of the gate, you're paying a nearly 40% premium to buy into EFC compared to the rest of the sector.
Wow, okay. 40%.
Yeah. And on top of that, the analyst data provides a discounted cash flow fair value estimate, which actually comes in at just $11.61.
So before we gloss over that, let's translate discounted cash flow, or DCF, for a second. It's basically a financial reality check, right?
Exactly.
You look at all the actual cash this business is projected to generate from here to eternity, and you calculate what that giant pile of future cash is worth in today's dollars. And the analysts are saying the underlying math pegs EFC's true value at $11.61.
But investors are currently paying over $13 a share. The math simply does not support the current price tag based on organic cash generation.
So basically, it's kind of like paying a luxury markup for a high-performance car, but the engine might actually be struggling to support that kind of mileage.
That is the structural red flag we really need to focus on. The analysis flags that the 12.4% dividend is currently weekly covered by both actual earnings and free cash flow.
Weekly covered. That's never a phrase you want to hear with a dividend.
No, it's not. When a company pays out more cash than its operations organically bring in, they have to find that money somewhere else. And to compound that stress, EFC investors are facing roughly a 7% annual share dilution.
Oof. Okay, this is where the money printing machine analogy really bites. If I own shares, my slice of the overall company pie is physically shrinking by 7% every year because management keeps issuing new shares to raise capital.
Precisely.
And let's look at the mechanics of that from the company side. If you dilute your share count by 7%, you now have 7% more shares outstanding. That means you physically have to generate 7% more total earnings just to keep paying the exact same 13-cent monthly dividend to everyone.
It creates a relentless treadmill effect. It puts tremendous pressure on the company to hit aggressive, continuous growth targets just to tread water.
And if they stumble?
If they don't out-earn their own dilution, they risk cannibalizing their own equity to fund the payout, which eventually forces a dividend cut.
Okay, so compared to last quarter, what actually moved the needle here?
Let's break down the actual cash generation from their Q4 2025 earnings report. It was a decidedly mixed bag.
We'll lay out the bad news first.
Starting with the headwinds. Total revenue fell 8.6% year over year, down to $65.81 million.
Wow, 8.6% drop.
Yeah, and that vastly missed Wall Street's estimate of $90.74 million. But on top of that top-line revenue miss, the company took a brutal $64.7 million one-off loss on certain securities.
Wait, a $64.7 million hit. That is not a small rounding error you can just sweep under the accounting rug.
No, it is a significant dent to book value. But I'd argue the more systemic issue underneath that single loss is their margin compression.
Okay, what do you mean by that?
Well, their net interest margins dropped to 3.37% in their credit portfolio and down to 2.18% in their agency portfolio.
Let's pause and explore why that's happening, because net interest margin is essentially the core pulse of any lending business, right?
Absolutely.
It's the difference between what they earn on the assets they own, like the interest from loans, and what they pay out to borrow the money to fund those assets. If the margin is compressing, the gap is shrinking. Why exactly are their asset yields lowering?
It really comes down to the mechanics of the current macroeconomic environment. Borrowing costs, meaning the liability side of their balance sheet, remains stubbornly high because short-term interest rates hadn't aggressively fallen yet in Q4.
Right, rates were still elevated.
Exactly. Meanwhile, the yield on the assets they hold started to drop. This happens due to a mix of older, higher-yielding loans rolling off the books, spread tightening in the broader mortgage market, and prepayments.
So you're paying a premium to borrow, but earning less on what you lend out.
Precisely. You're getting squeezed on both ends.
But the market didn't completely panic after this report. Like, there was a silver lining that kept the stock price relatively insulated.
Yeah. The silver lining was found in a metric called adjusted distributable earnings. Despite missing revenue estimates and taking that massive $64.7 million realized loss, EFC reported adjusted distributable earnings of 47 cents per share.
Okay.
And that actually beat the analyst estimate of 46 cents.
Let's decode that jargon, because adjusted distributable earnings sounds like a phrase invented in a corporate laboratory somewhere.
It kind of is.
It is management's preferred non-GAAP metric, right? Basically, it represents the actual cash profit the company can hand out to shareholders, deliberately ignoring those massive on-paper accounting losses. It's the cold, hard cash that actually hits the vault.
And that cash metric is what dividend investors care about most, because that 47 cents comfortably covered the 39 cents required to pay 3 months of their 13-cent monthly dividend.
Okay, that makes sense.
In addition to that, their trailing 12-month net margin still sits at a very robust 37.1%. So they are still highly profitable on a cash generation basis.
Hold on, how does that actually affect EFC's stock price for regular investors like me? Because hearing about massive $64 million losses and revenue missing the mark by millions usually means the stock tanks. Yet it seems like management put some kind of floor under the stock.
They did. And the floor held because management executed some very aggressive defensive maneuvers with their balance sheet. They didn't just sit there and take the margin compression. They actively restructured their liabilities.
What kind of restructuring?
The most significant move in Q4 was closing a $400 million senior unsecured notes offering. They took those proceeds and used them to replace a large chunk of their short-term repo financing.
Oh, wow. Okay, we have to unpack repo financing because it is the silent killer of mortgage REITs.
It really is.
Repo financing is basically short-term borrowing where you pledge your actual assets like mortgage bonds as collateral to a bank. It is incredibly cheap, but it carries a lethal risk called mark-to-market.
Yeah.
If the market value of your collateral suddenly drops, the bank calls you up and says, hey, your assets are worth less today. We need millions of dollars in cash from you right now. That's a margin call.
And margin calls are historically what bankrupt mortgage REITs during financial panics. I mean, they're forced to sell assets at rock-bottom prices just to meet the bank's demands, which locks in massive, unrecoverable losses.
Right. It's like taking out a daily adjustable rate mortgage on a house whose appraised value changes every minute, and the bank can demand the difference in cash every single afternoon. It is incredibly stressful.
Very well put.
So by issuing $400 million in senior unsecured notes, EFC essentially locked in long-term debt that doesn't have those daily mark-to-market margin calls.
Exactly. It fundamentally changes their risk profile. Now, to be clear, their overall leverage is still undeniably high at 9.20x debt to equity.
9 times as steep.
It is, but their recourse debt-to-equity ratio, which is the specific debt where lenders can actually come after the company's core assets if things go bad, that's stabilized at a very manageable 1.9 to 1.
Okay, so that drastically improves their financial flexibility. They replaced volatile, short-term, risky debt with fixed, safer debt so they don't get foreclosed on if the bond market hiccups.
Yep.
Which brings us to the next logical step. They restructured their debt, they raised this new capital, but what are they actually doing with that money to fix the margin compression we talked about earlier?
This is where we see the underlying DNA of EFC actively transforming. Historically, a lot of mortgage REITs rely heavily on agency MBS, mortgage-backed securities that are guaranteed by government-sponsored entities.
Right, like Fannie Mae and Freddie Mac.
Exactly. They are very safe from credit default, but they are incredibly sensitive to interest rate changes. EFC is deliberately shifting its capital away from traditional agency MBS and aggressively pivoting toward corporate CLOs, or collateralized loan obligations.
Oh, wait, they are a mortgage REIT. Mortgages are literally their namesake asset class. Why would they abandon traditional mortgages to buy bundles of corporate loans? That is a completely different ballgame.
They're abandoning the pure mortgage model as a survival tactic, essentially to smooth out earnings volatility. Traditional fixed-rate mortgages get absolutely crushed when interest rates rise.
Makes sense.
CLOs, on the other hand, are typically constructed with floating-rate corporate loans. So when interest rates go up, the interest generated by those corporate loans also goes up. It acts as a natural hedge against the exact environment that has been punishing traditional mortgage bonds.
I see. So instead of fighting the interest rate current with fixed mortgages, they are riding the current with floating rate corporate debt.
That's the idea, yeah.
The strategic goal is to chase superior risk-adjusted returns. And looking at the Q4 data, this pivot is clearly underway. I mean, their credit portfolio grew 15% quarter over quarter, reaching a massive $4.11 billion.
It wasn't just the corporate CLOs performing well either. We need to look at how they are diversifying outside of standard loans entirely. Their Longbridge segment had a standout quarter.
What's Longbridge?
Longbridge is their reverse mortgage origination business, and it brought in $16.4 million in net income.
Oh, which makes total sense as a diversifier. A reverse mortgage is essentially a homeowner selling their equity back to the lender while continuing to live in the house.
Exactly.
It's tied to home prices and demographics, specifically an aging population, rather than just pure interest rate movements.
Spot on.
And when you combine that segment with their broader investment portfolio, which generated $43 million in net income fueled by the new credit strategy, you start to see the blueprint. Management is trying to find high-yield pockets outside the hyper-competitive standard agency mortgage space.
Yes, they're hunting for yield wherever they can find it efficiently.
Right, but what does all that actually mean for EFC investors? Because we can talk about floating rates and reverse mortgages all day, but when I look at the big picture, the analysts are forecasting that EFC needs to hit roughly 27% annual revenue growth just to offset that 9.0x leverage and the 7% share dilution we discussed earlier.
Yeah, that is the ultimate bottleneck right there.
Exactly. I mean, is pivoting to corporate CLOs genuinely enough fuel to hit 27% revenue growth? Because if the strategy falls short and they miss that aggressive growth target, the underlying cash flow won't support the dividend, and that 13.8x premium PE ratio is going to collapse.
And that is the multi-million-dollar debate causing such polarization around the stock right now. If we objectively weigh the two sides, the bull case points to resilience. EFC maintained a highly impressive 37.1% net margin despite taking a heavy one-off loss.
Right, they survived the hit.
They did. And they've successfully diversified their portfolio away from pure interest rate risk. Furthermore, with the broader macroeconomic environment showing stabilizing interest rates and the Fed looking to cut rates, EFC's borrowing costs should theoretically come down.
Which would expand their margins again.
Exactly.
But the bear case is staring right at us, and it's built on the current mathematical realities, not future theoretical cuts.
Correct. The bears will point out that you are paying a 13.8x premium valuation for a company that is actively experiencing margin compression today. I mean, their net interest margins shrank this quarter. The overall leverage at 9.0x leaves very little room for error.
That's a lot of debt.
And perhaps most dangerously, by pivoting into corporate CLOs, they're trading interest rate risk for credit risk.
Ah, right.
If the economy slows down and those corporations start defaulting on their loans, the safety net is incredibly thin. The dividend coverage is already weak. A spike in corporate defaults could easily force a payout cut.
It really is a high-wire act. They're walking a tightrope between brilliant financial engineering and overwhelming debt pressure, and we won't have to wait long to see if they lose their balance.
No, we won't.
The ultimate test is coming up almost immediately. EFC is scheduled to release its Q1 2026 earnings on May 5th, with the crucial conference call happening the next day on May 6th.
That Q1 report is going to be the definitive scorecard. The market will be laser-focused on whether that 15% growth in the credit portfolio actually translated into stronger, sustainable free cash flow.
And if it didn't?
If the margin compression we saw in Q4 continued to eat into their bottom line despite the CLO pivot, the market's patience for that premium valuation will evaporate quickly.
It is going to be the moment of truth for that 13-cent monthly payout. So let me leave you with a final thought to ponder before we wrap up today's deep dive. We're entering a macroeconomic environment right now where the Fed is looking to actively cut rates and mortgage spreads are finally starting to tighten.
Right.
In that shifting landscape, is EFC's proactive shift away from traditional mortgages and into corporate CLOs a master stroke of risk management that will keep them miles ahead of the curve? Or, by chasing yield in the corporate loan market, are they secretly taking on hidden credit risks just to keep the illusion of that massive monthly dividend alive?
It's a question everyone is asking.
All right, listeners, what's your take on the future of Ellington Financial Inc. AFC? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.